Good afternoon, everyone. Thank you for taking your time out of your precious Saturday afternoon to join us in our ESG annual conference. To shed more light on the role of ESG investing in global sustainability efforts, we have curated this 2-hour ESG conference, Bridging Today, Building Tomorrow. We aim to raise awareness on the significance of nature, its potential for climate solutions, its provisions for people, and the economy's dependence on it. Part 1 of the conference is a panel discussion with our panelists, Dr. Fraser, the Associate Professor and Dean's Chair from National University of Singapore, Mr. Wayne Bishop, CEO of King & Shaxson Asset Management in UK, Mr. Geoff, Howie, Market Strategist of Singapore Exchange, and the moderator will be Mr. Stephen Bing, the Head of ESG Strategy from PhillipCapital Management. Part 2 features 2 ESG products by Manulife Investment Management and UOB Asset Management, respectively. Without further ado, let us welcome Mr. Luke Lim, Managing Director of Phillip Securities Private Limited, to give the opening address. Over to you, Luke.
Thanks, Josephine, and I want to thank my panel and also investors, foreign investors, for taking the time to join us today. Today, our ESG conference is called Bridging Today and Building Tomorrow. And I really like the ring of this title. It's so deep. It could even be a life mission. Building Tomorrow is about taking charge of the future. It has an optimistic ring to it. And Bridging Today suggests that we are not there yet. It's something that we need to cross, but we need to make the steps to move from A to B. And I think Bridging Today and Building Tomorrow very much sums up the ESG efforts that we have as a community. ESG is already in Singapore. Just look at today's National Day's recent budget, National Day's budget of the Singapore Green Plan on the green economy. In addition, the public sector will also be developing green bonds of issuing up to 35 billion in green bonds. And this provides a great opportunity for the country to develop itself into a green financial hub. Therefore, Singapore's green plans is building for tomorrow. Investing is also close to the human core value. For example, when we buy a home, we want to provide for the family. We want our hard-earned money to go in investments that reflect our personal values. So today, we are also trying to bridge between our values and our investments. How can the two meet? And especially in such a time like this with wars and pandemic, these only reveal to us what is only really important. It takes away the noise and therefore allows us to focus on what is really crucial. In a recent US investor survey of retail investors, 50% now do consider and require that the companies they invest in align with their values. However, no more than 13% of investors do not do or only do a lot of research. Only 13%. 50% say they want to invest in companies that are aligned to their values, but only 13 investors, 1-3, do the research. And therefore, many of you all here are the 13% willing to take the next few hours to do the research with us. Today is also something very special because we have the academia, we have fund managers, we have people from different countries at the exchange, the brokers coming together and investors coming together to discuss how we can save our planet as well as make money at the same time. Therefore, I would like all of you to ask the questions throughout the panel. What is the framework? How do I make it work? What is green investing? How to prevent greenwashing? Does green investing really affect my investment performance? These are many great questions as we bridge from today, as we bridge your understanding today. So take the time to ask all these questions later in the panel. Please also stay tuned in our next ESG conference and upcoming ESG events as well, and the upcoming ESG content that we'll be producing. And my final wish list for all of you here as Poems investors will be to encourage others and build bridges and build tomorrow together. Thank you. Over to you, Stefan.
Great, thanks a lot, Luke. I really appreciate the time taken by our guests, Geoff from SGX, Dan from NUS, and Wayne all the way in the UK, waking up early for this. It's great to have three different people from taking sustainability from three different lenses. It's very, very important, especially for us in the financial markets to lose track of the bigger picture. It hasn't taken us long, right? As everybody knows, since the industrial age, beginning in the 1760s, to place ourselves in the climate crisis we are in today. From the innovation of power-driven machines and engines to technology of today that accelerates production, extraction, and even occupation of natural resources and space, much of which are causing the problems, being emissive, being destructive, being pollutive as well. So we have to keep track of the fact that technology and innovation today can also help in the reversal of a warming climate and stemming the loss of biodiversity, which are two of the biggest issues, environmental issues, that are threatening the global economy today. Today's war on Ukraine, as you all know, has driven global impacts almost immediately. Conflict doesn't just consume lives of human beings, but also of our natural resources. And in a place like Ukraine, being an important agricultural nation, right, feeding sunflower oil, barley, corn, and potatoes, one of the main suppliers, no less, has an impact immediately on our supplies. And therefore the need for peace that drives prosperity, which many of us enjoy, many of us don't, but it affects life as we know it, right? So surviving this pandemic as well, of all things, right, in the midst of a pandemic, it's still a good time for us to build back better. And through its lessons, I think realigning our relationships with nature is something that we can take away, and something we'll focus on today in terms of what we see in science and what research is doing to back up, right, actions that need to be taken. What are we doing in terms of industry leadership and helping the companies along and the financial firms along, as well as how we're taking action on the ground as fund managers in Wayne's case, right? So we have to take things in that perspective of what is ecosystem service, why is nature so important to the economy, right? In a natural world that drives. It's the capital, right, that feeds us, food, medicine, energy. It keeps the natural world balanced. It benefits our well-being. It also makes our business world go round. In food system alone, as you all know, is valued at $8 trillion, almost 10% of global GDP, right? So informed judgment has to continue to guide the flow of capital towards countries and companies that need to transition to a net zero and circular economy, and that's something that we try and actually have committed to at PhillipCapital Management too. A transition also that is just for the people and also nature positive. So on that note, maybe I can turn to Dan. From a research perspective, what does science strive to do or to achieve in this bigger campaign to stem a warming climate and biodiversity loss? Dan?
Thanks. First of all, thanks for the invitation. Really happy to be here. I think science has not the only role to play in solving and addressing some of the challenges we face, but it is obviously a key part of it. And I think there's probably a couple of different angles to that. First of all, we need to know what the scale of the problem is if we're going to try and manage the situation. So, science is key to helping us understand the boundary conditions that we're working in, the problems that we're facing. So we know, for example, now that we have to stem climate change at 1.5 degrees above pre-industrial warming. Without that, we start to see the catastrophic impacts and runaway feedbacks and things like that. So, science has helped us to know, the problem and where we reach a point of no return in some respects. But I think science also has a role to play in helping us figure out the scale of the solution and the types of solutions that will help us address those challenges. So, to give you one example, we know that nature-based solutions to climate change using the natural environment for climate change mitigation, might get us somewhere like 20% of the way to offsetting or mitigating climate change. And we know how many, billions of tons of carbon a year that our natural environment is able to offset. It's only 20%. It's not the whole solution. It is not an excuse for decarbonization of our economies, etc. But we know that the scale of potential solutions, and nature-based solutions being one of them. We can also use science to set targets and to know the scale at which a particular solution is feasible for a particular situation. So if we want to benchmark our efforts, we need to be able to set realistic targets. So we can use science to do that as well. And then I think probably the last aspect of which science plays a role is the monitoring of those targets, so that we're actually achieving what we say we're achieving. And this is essential in the carbon credit market, because we're talking about financial transactions, not giving away money for free, but in return for a set number of carbon credits that can be used for offsetting. And we need to know how much carbon has been offset, and has it truly been offset, etc. So that kind of monitoring, reporting, and verification is also a very kind of science-informed process. That being said, when we don't have science, we can't use that as an excuse for inaction. So science is important, but we also can't use it as an excuse if we don't have enough science for a particular situation. Thanks.
Well said, Dan. It's important to monitor and to be able to measure once we do have set targets, especially when science backs up a date to that as well. But you're right. I mean, we're at a point where action is better than inaction, and from all fronts as well. Thanks for that. From an industry perspective, Geoff, as a strategist, what's SGX focus or role in our race to net zero?
We have many roles, Stephen. Many roles. I guess probably one that I would want to bring up right now, given what we were just discussing, is on the back of that demand for voluntary global credits. In carbon emissions, the Climate Impact X is, if it's okay, I can talk a little bit about that right now, because it's very relevant, having that science-based approach. So Carbon Impact X, it was jointly established by DBS, SGX, Standard Chartered, and Temasek. It's a global B2B marketplace, really an exchange, headquartered here in Singapore, and it's for high quality carbon credits. It's developing several platforms that can offer some flexibility to serve the different needs of the different credit carbon buyers and suppliers. So there's really three aspects of it. The first is the project marketplace, which will offer a curated selection of high quality carbon credits that can meet the different corporate sustainability objectives. But where I wanted to bring this up, because I can talk about some action. The CIX auctions, which we'll be looking at again this year very soon, I think around mid-year. It's going to provide a digital venue for discovering prices of unique or new credit-bearing projects and portfolios of credits and so forth. So we actually did have a pilot auction in October last year, where we cleared 170,000 carbon credits from 8 natural climate solutions, and those 8 climate projects, I should say, and they were cleared at $8 per ton. It was supported by 19 buyers from across various sectors, and the carbon credits, they're certificates basically that represent an independently verified reduction of 1 metric ton of carbon dioxide emissions. So those 170,000 carbon credits, they came from reforestation and avoided deforestation initiatives. That was across Africa, it was across Asia and Latin America. So the natural climate solutions that I guess protect and restore natural ecosystems, like there's ecosystems like the forest and the mangroves and so forth, these solutions are seen as very cost effective way to support the biodiversity that you were talking about in the introduction, Steven, and also generated income for the local communities, which is a big part of ESG. So that's the second part, the auction process. Then the CIX exchange by year end will enable two-way spot trade of high quality carbon credits through standardized contracts, of course, in a real-time trading platform. So that will also be providing liquidity, it'll be providing clear price transparency, and will also support the risk management demands of the market. So that's one of the many initiatives that we're working on, but I just thought I'd bring that one up right away because I thought it was very relevant to where we were in this conversation.
It is definitely. Thanks for that, Geoff, because that is one way that the exchange and regulators can come in to support the industry in terms of trade and meeting targets. We will talk about that a little bit more in a short while because it is important for the audience to understand the mechanisms and really the reasons for that trade and therefore helping these sort of companies, the high emitting companies that are trying to make a difference in their emissions reduction, for example, and therefore going to a marketplace like that. Maybe coming down to the firm level, Wayne, you've been at ESG investing for a number of years, for quite a while. What is ESG investing to you?
Good question. I think you have to begin with understanding that obviously the modern lifestyle, the industrial revolution that started hundreds of years ago has been perhaps the catalyst for many of the global problems we have today. And of course, that all came around money and understanding that business and actually capital has an important role to play in making these things happen. I think science is very important. We must understand the science. If we don't understand the science, we don't know what we're doing. But I think perhaps one of the biggest catalysts I saw in the last couple of years in ESG came from the pandemic. Because what we did is people actually got to experience some of what the science has been saying. The science has been telling us a long time about carbon emissions. Science has been telling us a long time about pollution. I live in Northeast London. When the pandemic hit, the traffic stopped. I could walk out my door and breathe fresh air, and it was wonderful. And these were the kinds of things that were catalysts in people's minds, because the science, the words, the things that are happening in other parts of the world were driven home to people. And that became a catalyst for ESG investing in a way that it hadn't been for about 20 years. Now, I've been doing this for about 20 years. I believe it's our legacy as a generation. 20 years, at school, we were learning about global warming. It was an alien thing. It was what pop stars did. Now, of course, it's reality for everything. So when I bring it back to your questions, what does it mean? Well, in industry, what did it mean for us? Well, it meant adding a new criteria to how you invest. Investment's always been very professional. It's been very objective driven. So you knew what your sort of financial objectives were in how you manage money. Suddenly, you have to insert a new criteria. And this criteria is coming either through consumer demand, or it's coming through law, and it's coming through risk of your investments not obeying the law now. So it's not really, I would say, an option. I think this is happening by various laws coming in. And what it is you're just simply adding a whole new set of criteria. The environmental, the social, and the governance are the three that would be obviously the three that make up ESG. So you're beginning to look at carbon intensive industries, and you're beginning to look at how does it get resolved. Now, we talked about carbon credits, which I think is very important. I remember listening to Lord Stern, who was responsible for the UK carbon credits, lecturing at the LSE about 15 years ago. He was saying what the price was. It kind of got pushed aside because of various financial crises, and we saw the carbon credit price sink for a long time. And then, of course, people were buying them up, and of course, now they're very glad because we now have a situation where carbon price has gone through the roof. But this has actually forced change. It is making people make change. It has forced a whole change in the whole generation industry. And we are beginning to see the benefits of that now. And I think this to me is what ESG investing is about. It's about then you applying your capital to doing the things that are more positive, but taking into account that there is an environmental cost to everything you do, there are social costs to everything you do, And governance is perhaps a little bit more tick box, but it's also very important in the big picture. And these things will make these things are beginning to make those tangible differences. So we've gone from being something that was talked about 20 years ago. I remember when the first ESG funds were coming out in the, when I was starting in the city in the 90s. I remember one of them being called the Brazil Fund because you had to be nuts to invest in it. Was basically the whole logic of it. I spent 20 years of my life being told, this is not for grown-ups, this is not the real thing. And now, of course, it has changed because we're now seeing the whole market understand that this is going to come, whether we like it or not, and investors are demanding it. And it is, to me, ESG is one half of the story. The other half is impact, about proving you're actually doing something that is positive, but we'll come back to that another stage. But this is just the overlay of these considerations, everything from carbon to water stress, because carbon sort of gets the headlines because it's the elephant in the room. But you've got water stress, you've got the welfare of people, you've got biodiversity. That is becoming increasingly important because we're beginning to realise that if we get that wrong, that can be just as bad. We've got all these issues, they're being priced. Data, the mechanisms of being able to manage huge quantities of data that was never possible, say, even 15, 20 years ago, has enabled us to effectively price, realise and understand what's going on. And as I said, that is coming along with the fact that experientially people are beginning to understand global warming a lot more and some of the consequences. And I believe all these factors are going to continue to drive the industry further.
They are indeed. Aren't you glad to have reassurance of your life's work finally come to fruition with the backing of everybody else that's come to terms with the bigger picture? So it is good to have nuances in how we strategize at the fund level, but it is definitely necessary to have clarity on the overarching issues, right? And having said that, maybe I'll turn back to Dan. Take full advantage of you being in your classroom at our own leisure today. Tell us a bit more about ecosystem services and what that's got to do with the global economy, and maybe a bit about what your center does at the NUS Nature-Based Climate Solutions Center, what you do with blue carbon and how you measure and how that works into what Geoff shared with CIX.
Sure. Yeah, I mean, ecosystem services are really the foundation. I think you mentioned it in your introduction of all the types of capital. Natural capital is the foundation of that. And the great thing about natural capital is it's largely provided for free. It's on our doorstep, and we've taken advantage of it and for a long time. And so a lot of my research has been around quantifying that natural capital. And try and work out exactly what those benefits are, whether it's the benefit of offsetting climate change, whether it's using ecosystems to protect our shorelines or trap our pollutants, improve our air quality and reduce our urban heat island effect. These are all examples of ecosystem services which the natural environment is providing. But to get natural capital into a lot of these conversations, we've realized that we can't just talk about how great the environment is in abstract or fluffy terms, but we need to try and quantify it, conceptualize it, and translate it in languages that other stakeholders use. Not to say that everything about the environment can be quantified, or nor should it be quantified. There's a lot of things that shouldn't, and leads us down a dangerous path if we do, but at least getting the natural capital into the same sort of conversations that other types of capital are involved in, we found as particularly in Singapore to be a very fruitful line of discussion, and it's helped us communicate with stakeholders that we wouldn't normally have communicated with. So that's kind of the broad setting, I guess. Within our center at NUS, the Center for Nature-Based Climate Solutions, we focused predominantly on the aspects of ecosystems or natural capital that will be able to help offset or mitigate climate change. And these are our natural climate solutions. And these are primarily how we protect, manage and restore our forests and other vegetated ecosystems, particularly tropical rainforests, which we have still a large area in Southeast Asia, which is able to contribute to removing greenhouse gas emissions from the atmosphere. But one thing that I'm particularly interested in is what is in my virtual background, which are coastal ecosystems such as mangroves and seagrass meadows, which are, I guess, the new kid on the block in terms of natural climate solutions, because they're vegetated coastal ecosystems that are able to trap huge rates of carbon dioxide from the atmosphere and store it at really high densities compared to other ecosystems. 1 hectare of mangrove stores as much as 5 times as much carbon as a tropical rainforest in 1 hectare. And it's because they have waterlogged soils and they're able to accumulate carbon over thousands of years, which is not the case in some other ecosystems. So you get a lot more kind of bang for your buck with blue carbon. Of course, the opposite is true, that if you lose blue carbon habitats such as mangroves and seagrass, you lose disproportionately more carbon into the atmosphere as well. But certainly these high carbon densities have made them kind of a key candidate for natural climate solutions and for carbon credit projects. But we're still in the kind of the pilot stage of understanding how blue carbon ecosystems can get into some of these projects, because a lot of the existing carbon credit project structures are based on terrestrial ecosystems and terrestrial governance and terrestrial economics, and some of that can be applied to the coast, but not all of it. There are some peculiarities about coastal ecosystems, particularly how we measure the carbon, because 70% of the carbon in a mangrove and 95% of the carbon in the seagrass meadow is in the soil. And soils are very hard to monitor rapidly and accurately. So there's still a lot of science behind that as well. But certainly we have enough science to start translating it into projects. And we're seeing huge demand and interest in blue carbon projects as a type of kind of high quality or premium carbon credit. And we're seeing just this year a rapid explosion of blue carbon projects and blue carbon credits coming onto the market. So it's a really exciting time. It's taken us a while to get there, but blue carbon is certainly catching up with the other types of natural climate solutions.
Great. And so it's not that easy. It's not as easy as planting trees or just buying a plot of mangroves. There's more to it to ensure that they are high quality. Maybe Geoff, if you can elaborate on what you shared a while ago on CIX's mechanisms. What is it that you look for, and what is it for? Or what are companies using that for? I mean, we touched a bit about that in terms of how they're reducing their emissions, but just the mechanisms and offsets, really.
Yeah. Look. It's not the panacea as I guess Wayne and Dan have alluded to. We've got a number of things for the companies to work with as well. So this is obviously the carbon exchange ImpactX is effectively a platform, but we've also got procedures and we've got products for companies to work with as well. Very important, I guess, is ESG, as we've said, and these issues such as the conservation and so forth, they have become mainstream considerations for businesses today. We've seen this very sustained increase in companies that look to report and reduce their carbon footprint and impact that they're having on these ecosystems. Singapore listed companies, they have been providing annual sustainability reports since 2016 that complements their financial reporting. And those environmental targets are real and tangible and being standardized, and in multiple cases being ramped or brought forward. So this is also paving the way for investors to play a pivotal role in directing capital to companies that are achieving those environmental targets. So while the companies can obviously participate in the buying of carbon credits and so forth through this platform, there's also a number of ways that they can look to report, reduce, and at the end of the day, it's the investors who hold the capital, and hence the ability to direct capital away from companies that are not reaching those environmental targets. So as we said, these environmental targets, they are real, they are tangible, and they're being standardized in many cases. For the outright carbon emissions, the energy consumption, the carbon intensity metrics, they are really among the most popular metrics that are being adopted by companies. You know, with that latter metric, I guess, of the carbon intensity is really proportioning carbon emissions to financial or broader business metrics as well, which we're seeing in our sustainability reports. So you had those emission scopes, scope 1, which is obviously the direct emissions, scope 2, the indirect greenhouse gas emissions, and then scope 3, which is really to do with the supply chain, and still quite a bit of work's to be done in that aspect. But that's a really important aspect of it. And I you know, there's also, as I said, there's products, including futures contracts, ETFs, and so forth that are relevant. And there's also other platforms apart from carbon, the CIX, the Carbon Impact X project, because I just wanted to touch on what Wayne was saying as well. Water is super important as well. And we're rolling out a platform here for the issuers and the investors to make, you know, to obviously make more of an impact on the conservation that Dan was talking about as well. And we've rolled out 27 key metrics. Now, that's playing a very big, small part in the overall taxonomy, but these 27 metrics include 7 metrics across the environmental scope. So it's not just greenhouse gas emissions, it's energy consumption and it's water consumption, looking at total water consumption and water consumption intensity, and also looking at waste generation as well. So that's a platform that will be rolled out in the course of the year. The issuers, which are the corporates that are listed, will provide the information on their metrics, and the investors will have free access to that. And as I said, that can help them to make the important decision of where they allocate their capital. Because at the end of the day, you know, getting that sense of urgency into the investors is something we want to help with, and getting the more transparent, quick, reliable information is a really important part of the process that we are going to play.
Thanks for sharing that, Geoff. It is a good initiative by SGX to try and harmonize the standards and the risk management framework. I think that's a really good start. At least locally, all the listed companies are able to follow a set standard, and then the assessors, as not just the reporters, but the assessors as well, have a better time or easier time to do the measurements and even the monitoring, right? You've got quite a few companies already on that list, and it is available to most of us.
Yeah, that platform will be rolled out this year, but I could share with you that Singapore Straits Times Index, and Luke will be rolling his eyes because I'm plugging our STI amidst a very important conversation. It has been the strongest index across Asia Pacific so far this year, but what I can tell you is the strongest stock in the STI has actually been Sembcorp Industries, which has gained 23% so far this year. Sembcorp Industries was among the top 10 stocks ranked by net institutional inflow last year, and it's ranked number 11 so far this year. And what's important about this company is that it has been pressing on with a strategic transformation of its portfolio from brown to green energy. It aims for its sustainable solutions portfolio to comprise 70% of the group's net profit by 2025, which would be up from around 40% at the end of 2020. So it's been structuring a transformation plan to really support the global energy transition as well as sustainable development in Asia. And as we saw, it's very much aligned with what Singapore is also looking to achieve by increasing the carbon tax rate, I think by about 3 times over a decade. But nonetheless, as you said, is that platform there? The platform will be there, but at the moment we do have plenty of stocks that are on board this train. Great.
Wayne, what's going on the UK and the EU side? I mean, they've gotten quite a lot of harmonizing of standards going on. I think the Article 9, for example, is used as a benchmark in taxonomy, and over in Singapore, the MAS is also trying to do some standardization of categorizing and definitions and of sorts, so that it's easier for all. Do you think that helps with the role of FIs in the bigger picture that we're talking about today in climate action and nature protection and what our investments can do?
I think there's definitely some help, because it gives the regulatory legitimacy, if you like, to what is going on in the industry as a whole, as it is at the moment. So, you know, there's obviously controversies going on at the moment. Obviously, the problem with anything that comes out of the EU is it gets mixed in with a lot of national politics, and we've seen that with the nuclear issue and with the gas issue, for example. And so it's not perfect, but at least it's keeping the debate at a high level. And at the moment, I still think there's a bit of a global land grab going on for trying to define ESG, for trying to get, you know, trying to sort of get the gold-plated products. So we're going to see a lot more activity, I think, in the coming years on this. And I think it is all very positive noise. It is good to be debating this. It is good to be asking the question, because I think, obviously, financial institutions play a very, very powerful role in what is going on. And I think, really, the way that they have moved, because I think the market has moved for the regulators here, by and large, has been because, one, client interest, two, because the sector has matured. And I think this is perhaps one of the things that that I think sometimes sort of goes under the radar. When I started in the city, the only option for renewable energy was hydrogen, really. Wind was a crazy idea, maybe power black and white television, but really wasn't great. And then you had companies like Vestas Wind Systems, one of the global leaders, the Danish company, come along. And it's gone from being a sort of small cap, an exciting company, a growth company, through to being really a rather large, boring large cap now. And a number of companies have grown up that way. China has played a very, very pivotal role in the rise of the solar panel. It was dominated by the Germans. They were laughing at the Chinese back in sort of 2008, saying they'll never take over. China says, we're going to make something of this. And those cheap solar panels have made a huge difference to what goes on in the world. You know, I live on a wet and windy island. If anyone who knows the UK, it's very wet, it's cold, it's windy. So we have lots of wind power, but we have an awful lot of solar power. You go up in a plane, you see solar parks everywhere. And if they work where we live, they work anywhere. And that is because the price has come down, because basically money was backing the Chinese movement to become a global leader here. It's also forcing companies to change. One of the leading sort of European ESG stocks or global champions is a company called Ørsted. When we were building all the offshore wind farms in the UK about 10, 15 years ago, I was incredibly frustrated, because every time a wind farm goes up, you think, oh, great, who's getting involved? And you'd be looking and you go, oh, Danish oil and natural gas again. You know, a no-no in most people. And it was so frustrating. Overnight, they had a road to Damascus experience, said, you know, they could see the way that the financial industry was going, said, that's it, off with the fossil fuels. And they had a very rapid transition plan. And they become obviously the global leader in sort of offshore wind farm development. And to sort of give you an idea, yesterday off New York, they auctioned just short of 500,000 acres of offshore wind for $3 billion. Way over the price of the previous one, way more than any oil field got. And that gives you an idea of how the weight of capital is moving. And this is obviously the number one responsibility of sort of financial institutions, to allocate capital. So we're seeing it happen. And I think really for financial institutions, it has been a difficulty, because you've had to change your thinking. You've had to change from not taking ESG into consideration to suddenly taking it seriously overnight. And of course, different parts and different markets are coming in at different paces. But I believe now that because they're beginning to have to take it seriously, because it has been taken seriously, the weight of capital allocation is changing dramatically. But it comes alongside, I think, the fact that the market has matured, because one of the hardest things I found when I started, if you like, was there was a shortage of decent mid-cap safe investments. And of course, we have to make financial sense in our business. We can't just run after every good thing. We still have to basically still make financial sense. Now, that whole middle area, if you like, is fairly full. You have a good choice now. So that has been part of the change. So I think the fact that the financial institutions are taking this seriously, the fact that the exchanges are taking it seriously, the fact that we're seeing banks take it seriously, and of course bank lending is perhaps the last area I talk about, because obviously how banks lend comes under a great deal of scrutiny now. And just the role that data plays in that. If a coal mine is opened or coal financing goes on, pressure groups are telling you who the banks are before anyone else. That kind of information is out there now. So it's sort of going down to a second level of, you know, how banks behave, how corporations behave. And it is having a great role in moving capital around and getting it into the right places. It's not perfect by any stretch of the imagination, but it's moved a long way, I think, particularly in the last 5 to 10 years. And I really do like to see how it move forward. Yeah.
Well, I'm glad we're moving it forward together. One thing we do have to take seriously is not to take nature as an infinite resource, right? So maybe I'd like to turn to Dan again, just circle back to you with the high quality offsets that we were talking about a while ago, so that at least people can understand that there are certain restraints and constraints that we have to work within when we do rely on a natural resource like mangroves, for example, to offset certain emissions or certain ways that we conduct business. So based on that, I mean, is there a time differential? I'll just ask an audience question for now. I mean, is there a time differential between taking a forest of mangroves that can sequester carbon versus and do that and offset the business and go on business as usual, for example? Dan?
Yeah, so
I mean, how long does it take for a forest to sequester or to absorb that carbon?
Sure. Yeah, I mean, a natural climate solution is not a get out of jail free card, right? It's not a replacement for the really hard job of decarbonizing, and partly that is because of some of the time lags involved. Particularly if there's a lot of interest in restoring some of the habitats that we've lost, and it takes time for a little seedling this big to grow into a mighty tree and be able to sequester carbon at a scale that's meaningful for climate change. And that can, depending on the ecosystem, that can take, 5, 10, 15, 30 years. Of course, we can also protect and avoid deforestation of existing forests, and then you still get a faster, and a more meaningful amount of carbon saved. But we have to be able to be realistic at what natural climate solutions can do, but also their limitations. And one of them is this time lag. But this, I mean, despite that, there are still many things that make a natural climate solution a very kind of premium type of offset, because you're not just getting carbon. So yeah, the carbon may take a while, but you're also getting all of these additional benefits for free. You're getting fisheries, you're getting support of local livelihoods, you're getting coastal protection, all of these kind of things. And in fact, some groups are now interested in bundling different ecosystem services. So there's one thing that's being discussed now called a resilience credit, which is a carbon credit associated with a coastal protection credit, linked to the benefits that having a mangrove or a coral reef has in terms of reducing insurance premiums and things like that. So we'll start to see, I think, different benefits of nature being bundled together, which helps us then get over some of these other issues with just relying on carbon alone. And this gives you a great benefit compared to other types of offsets. So credits generated from renewables or from carbon capture and all these kind of things, they're also all needed. They're part of the toolbox. But what you get with these nature-based solutions are all these extra co-benefits for free, and that really again helps you get have much more impact with a particular investment.
Thanks for that. That's for sure lots of opportunities if we just look a little bit outside, and this is the benefit you get also to get when we get scientists to talk to us, right? Is opening up new avenues and purpose for nature. I think we're almost running out of time. I mean, we're having a wonderful chat, but unfortunately, we probably have to leave some time for Q&As before I come back to you guys to close off. So Maybe I can go back to Josephine. Are there questions from, and we can open some questions to the audience?
Hi, Stefan. Yes, we have two questions from the audience. The first one is, what are the current sustainability challenges that you want to address, and how can we work with you to achieve it?
Go ahead, Geoff.
Stefan, you want to take this question?
If I could just have 1 minute, and hopefully
Sure.
I can give a okay answer here, but I think timing is really important. You know, there's a sense of urgency, and for companies, I know I'm looking at from the perspective of issuers and investors, right? That I work with. We've got to move quickly. So we had the COP meeting last year, and then on the 15th of December, we unveiled a new roadmap for our issuers, which are the listed companies, to provide climate-related disclosures based on the recommendations of the TFCD, the Task Force on Climate-Related Disclosures. It means that all issuers must provide climate reporting on a comply or explain basis in their sustainability reports for their respective FY22s now, and so forth. Now, that new regime, it's on, as we said, it's on climate reporting with the TFCD, but there is flexibility for companies to take a phased approach to gradually adopt those recommended disclosures. So some sectors will need to do it more quicker than others, and we have laid out a roadmap for that. So there's still, I guess, flexibility to determine, for the companies to determine what they disclose, but we think, it's been a good 5 to 6 years that we've been doing this reporting. So thankfully, a number of companies are quite mature in their reporting now, and that's what we can leverage off. But the key thing is for us to basically look at companies taking more responsibility in their reporting, and they're reducing, is moving quickly and moving with them.
Thank you,
Yeah,
Geoff.
good point, Geoff.
Yeah. Stefan, do you have anything to add on to Geoff's comments?
No, I'm just happy that we're working together at pace to make sure that sustainability reporting is something that's harmonized, because it helps then the financial institutions, right, to do the measurements and to actually filter out the metrics that matter. The metrics that matter that we need to measure, that therefore we need to monitor and base it against targets, and therefore tell the investors and our clients that yes, the portfolio is working. It's not just performing financially, but it is making the changes we say it's making.
All right.
Yeah.
Thank you, Stefan, and thank you, Geoff. Okay, we have another question over here. The question goes, are there ways to invest in carbon credits from the Singapore markets, like the ETFs covering EU and Californian carbon markets, etc.?
Yeah, there are a number of products. As we said, there's exchange traded funds that do apply a green tilt. There's the futures contracts that we have for the risk managers. We have a partnership with FTSE Russell as well as Nikkei to offer ESG linked equity index derivative products. We're also building Asia's ESG bond hub. But as I said, there are indices that do rank the stocks rank the stocks according to their sustainability sustainability focused initiatives, and then each, like I said, most of these stocks, investors can actually go and have a look and see how they are achieving and in line with the bigger objectives of reducing reducing emissions and managing their water supplies and so forth. There's, as we said, there's those emission scopes 1 to 3 that you can read about in those sustainability reports. But I might also mention one more aspect of what we've got here is our scientific beta acquisition that we made last year. This is an affiliate of the group. It's an index provider. It's based on academic foundations. It is considered to be a thought leader in smart beta and ESG solutions. So there are papers on their investing methodology. And I guess their low carbon offerings, which basically enable investors to be a part of this process of a transition to low carbon economy by reorientating their investments towards less carbon intensive activities, and that's on their indices that they are providing. So there are a number of options. If you wanted to be start from the basic building blocks, you can look at, as we said, the green related companies. That extends to the ETFs, the bonds, as well as the derivatives, and of course the scientific beta academic foundations as well. So I guess what we've got is a wealth of products and relevance. But what's really important too is the education and the information behind those products and those companies and so forth. And that's where Stefan's going to be really playing a key role with Phillip as well to help us with that, right?
I hope so, and so do all of you. Yeah, thanks for that, Geoff, and thanks for the questions. It is very important, and regardless of where you're from, I didn't see who the question came from, but regardless, it is important that even within a group or a company that we work together, you can see that through the panel and the experience of the panel today, there's an important way and means that we can infect. I know it's a bad word today, but also infect and influence and even inform, right? Science informs, positions in a regulatory body helps to influence through your leadership. And just the methods and the way we conduct our business and the way we choose and develop our strategies, even at the firm level, helps to turn things around. We have a fiduciary duty as an asset manager to invest accordingly, but through education and outreach, could we actually turn those duties into planet positive ones, right? Through investor education, just like the session that we have today. And as an industry, then Geoff, the influence that you have in as a regulatory body, taking steps ahead to help the industry along. I mean, that leadership is important, and that leadership isn't seen across the globe, is it? But as a society, right? Whether we're in academia or in policy or as a business or FI, I think that there's just some duties that we need to keep our focus on, in terms of making decisions that are sustainable for all life on planet, really. So I think Josephine, we'll probably have to cut because you need to port over to the next one. I'd just like to give an opportunity for our guests to leave some inspiring parting words, maybe starting from Geoff and then Wayne and then Dan.
Yeah, I thought those statistics that Luke shared at the introduction were very interesting. But just yesterday, I polled our interns at SGX and asked them to rate between 1 to 10 how important ESG compliance is in the companies they work for and the companies they wish to invest in. And it was interesting. So 6.2 was the average response for importance in companies they wish to work for in relevance of 1 to 10. And 5.8 for the companies they want to invest in. But what was interesting is they are well aware of the issues. There was one point where one of the interns actually said, it's really important to get away from the fossil fuels, but how do you do that when the fossil fuels are still so less expensive than there are sustainable sources of energy? So this gives me great encouragement for the future, how the current millennial generation and the younger, all the way to my kids who have learned the value of environmental conservation through their schooling. It gives me great hope. I mean, I remember when I was a postgraduate student, I had to actually go to the dictionary and look up what biodiversity meant. So we've come a long way, but still a long way to go.
Yeah, good point. Thanks, Wayne.
I think I always love a good ESG investment that is actually really focused on the positive. So for many years, it was the people developing renewable energy. I love the different technologies that were coming out. I love the boldness. I then love the way that we then saw the companies that went from being the developers to being the companies that were the builders, the owners, the operators, which are a very good form of income even today. And what I really like is we've seen a lot of battery parks going in the UK. So people have worked out the problem with intermittency of renewables. They're addressing it with battery technologies. They're addressing it with hydrogen storage. I just love the fact that, to me, there is a constant sort of wave of here's the next problem, go forward and address it. And finding ways of doing it profitably, you start seeing the big boys getting involved once these projects get going. To me, that is still one of the most exciting reasons for getting up in the morning, because there is a constant wave of it. And at the same time, one of the very first investments I got involved in was reforestation. And I loved that because I thought, yes, here we go. Upward investments, nothing's perfect, but it was actually there to sort of say, look, we've got to start filling up where we've been doing damage. We've got to start looking at how we can solve the problems, and again, doing it in a positive way. Doing it they did take care of a lot of the biodiversity at the time of where they were doing and what they were doing. So there's a lot of good out there, and there's a lot of opportunities out there.
Fantastic. Dan, over to you.
So I'm really excited by all of these conversations and the things that 10 years ago in academia we were saying, hey, everyone, this is really important. It's great to see that now that interest is really there and that it's mainstreamed, which I think is really important. That being said, we've got to make sure that this enthusiasm is used correctly, right? There is some misinformation around nature-based solutions and what they can and what they can't do, where they're appropriate, where they're not. There is a lot of maybe overselling and overhyping, and I think we have to, we want high quality offsets and nature-based solutions that are actually going to make a difference. And I think so there is some due diligence to be done there. And I think as long as these interventions are evidence informed, they're going to be good. And we're here to help you with that. That's our role as academics is to provide that evidence for you. This is what we do day in, day out. And it is really heartening that before COVID, this is not the sort of conversation I would have had. Post-COVID, this is a conversation I have twice a week with different corporate partners. It takes up a lot of time, but I think it's really important to do it, and it's just great that this attention is there. So let's utilize that attention correctly. We're here to help. We're here to collaborate, and I think we can all work together to make these nature-based solutions and all the extra benefits that they bring a reality.
Yes, indeed. Time well spent, though. We're all good company.
Yeah.
Well, I'd like to thank all of you, Geoff, Wayne, and Dan, for spending the afternoon with us. It's been a valuable conversation coming from the different lenses that you see things through. So over to you, Josephine.
Right, thank you. Thank you, Stephen, Geoff, Wayne, and Dr. Daniel for the very insightful panel discussion, and of course for spending your beautiful Saturday afternoon with us. Right, so with that, we will move on to the second part of today's conference. Right, so we will now invite Ms. Janice T from Manulife Investment Management, Singapore Private Limited, to share on the Manulife Global Fund's Sustainable Asian Bond Fund. Over to you, Janice.
Okay, hi, thanks, Josephine. Can I just check if you can hear me clearly?
Yes, loud and clear.
All right, so I'll be sharing my screen. Let me know if you can see.
It's good.
All right, so I'll start. Hi, everybody. Thanks for joining us again on a Saturday afternoon. My name is Janice from Manulife Investment Management. A very big thank you to PhillipCapital for inviting us in this session. So I hope you guys has enjoyed the session so far. Personally, I've learned a lot from the very insightful panel discussion earlier. So for this part of mine, I'll be sharing who we are in Manulife Investment Management. What do we do? What is our target on ESG? How we play a part in ESG investing, and why you could consider, our investment solutions in this space. And lastly, the solutions that we offer in this space, which I would like to discuss today on the Manulife Global Fund, the Sustainable Asia Bond Fund. Okay, so without further ado, let's get started. Now, I'd just like to take a quick few minutes to talk about who we are. So I think most people are probably more familiar with our insurance arm. We are part of the Global Wealth and Asset Management arm of Manulife Group. So we do institutional asset management, retirement solutions, and also retail investments. Currently, we have about US dollar 835 billion in asset under management and administration. So we do focus on having local presence. So we do have offices in 18 geographies and having about more than 600 investment professionals globally. We have a very strong focus in Asia. If you can see, it's the second largest population amongst the investment professionals, managing about 30% of the 800 billion US dollar that I've shared earlier. So besides fixed income, we do have other solutions offering as well on equity, multi-assets, and private markets. But today we'll just focus on our fixed income solution, specifically in Asia. So in Manulife, we have very strong commitments to sustainability. We have our ESG integrated in both our corporate culture and also within our investment process as well. We also take stewardship in ESG, whereby some examples is that we have about 81% of global green building certification across our global real estate portfolio. And also, when we are working with organizations, we try to influence them to focus more on the ESG elements or collaborate with them with different like NGOs, different affiliates to become more sustainable. And this is the team behind the scene. So it's a huge team. The portfolio managers have an average of about more than 20 years of experience in fixed income investments. We also have a dedicated ESG research team that works with all the different investment teams across the firm, just to ensure that the ideas and the messaging are consistent. So this is quite, I think, unique across the different asset manage amongst the different asset manager, because it is not having an ESG expertise embedded within the investment team, but we actually have a specialized ESG research team that works with the different investment teams. Okay, so since we are talking about Asia fixed income, I would like to take a quick few minutes to talk about why Asia fixed income before we really delve into the sustainability portion of Asia fixed income. So this chart here is showing a growth forecast, a GDP forecast of Asia versus the other countries. So if we're looking at the forecast for the next couple of years, Asia ex-Japan, that is represented by the green bar, still have a very huge growth potential. The other thing that you want to look at when it comes to fixed income investment is probably the credit rating, right? Credit rating is quite important. So here we actually summarize a chart comparing Asia versus other emerging markets, because most of the Asian countries are also considered emerging markets. So anything above BBB minus is considered investment grade, and anything below will be non-investment grade or high yield, right? So this is comparing over the past 10 years. Majority of the Asian countries are either in the investment grade category or has been upgraded in terms of their credit rating over the past 10 years. Whereas, on the other side, on the emerging market side, I think it's quite an opposite view. So this is where we say Asia having a very high quality market and also having the potentials. Now, the other factor or the other indicators that we generally looked at in terms of a high quality market will be foreign reserves. So foreign reserves could be cash or other assets such as banknotes or deposits, treasury bills that is held by central bank of a country to back liabilities and also influence monetary policy, right? So here we compare Asia ex-Japan, Latin America, this is Eastern Europe, Middle East, and Africa combined. So the foreign reserves for Asia ex-Japan is very, very healthy. It's almost 6 times of this Latin America and 3 times of the whole Eastern Europe, Middle East, and Africa. The last chart that I'll show you on why Asia fixed income is comparing the credit ratings and the yield of Asia country versus developed country. And mainly, these are all countries with similar credit ratings. Okay, so we talked earlier that Asia stands out compared against emerging market in terms of credit ratings. Now, if we are looking at similar credit ratings, what are the yield level that we are talking about, right? So amongst the Asia country, this is where you are still getting the positive real yield, okay? So these are some of the reasons why we think Asia fixed income has the potential and is something to look at. So if we put, or if we combine the sustainability or ESG element into Asia, let's look at, sustainable investing in Asia. So some of you might wonder, why ESG is. Sorry, can I please get people to mute your phone, please? Thank you. All right, so I'll continue. So some of you guys might wonder why ESG is important in investing, or what is sustainable and responsible investing, right? So sustainable and responsible investing is an investment approach that consider all the material factors, including environment, social and governance when evaluating an investment. So the aim is to ensure that the price of a potential investment reflects the full range of risk over time, because you do consider some of all these factors. And these support an investment primary objective of achieving sustainable return over a long term. Okay, so if we look at, or if we break it down and look at each specific ones, environmental factor consider how a company's operation impact the natural environment, such as water contamination or water scarcity or carbon footprint, etc. And if you look at social factor, that's where it's related to a relationship between maybe the company versus its employees, consumers, suppliers, or communities. So social factor can be of material consequences to company and investors, and it would have actually a knock-on impact over longer term. So for example, we have this company called Target in US. So they have actually suffered, I mean, not that we're invested in it, but this is just an example in general. So this is what happened to Target. So they suffered a data breach in the 4th quarter of 2013, involving the financial information of about 40 million customer, and also the personal record of about 70 million customers being leaked. So the whole expenses cost was about 162 million across both 2013 and 2014. In 2015, they have reached an agreement with Visa to reimburse the card issuers up to 67 million. And in the quarter following the announcement of the breach, they have experienced a 16% drop in earnings, right? So it's not just impacting the years when the data leakage happened, it actually had a knock-on impact to subsequent years, impacting the whole emotional and also the trustworthiness of the customers towards the company. Okay, so this is where we think that is quite important. And lastly, on governance factor, this is related to the structure of or system that is put in place to ensure effective direction and control of entity. So like poor governance structure could actually impact how whether there is any for example, your retirement benefits, how is the shareholder structure? So those will be under governance. Okay. So in Asia, we actually is facing some of the largest ESG risk and also opportunity in the world. Right, so sustainable investing in this region is actually gathering steam, and amongst all the different themes or different ESG topics, these are the three themes that our investment team is focusing on, and also what are we focusing on in the fund to achieve long-term sustainability performance and also positive ESG impact. So linking to the risk and opportunity that I shared earlier, like why Asia, right? So this is here, we have some stats that specifically talks about environmental issues in Asia. So for example, you have, Asia being home of 60% of the world's population, and they are actually, having more than 50% of carbon emission. And then you have 60% of the world's material use, and this one I've shared earlier. So these are some of the environmental issue that we think that's in Asia, but it also provide very good opportunity because encouragingly, China and India is having significant investment in renewable energy, where in maybe 1 of every 5 new bonds issue, they are actually green. Okay, and China as well has a goal of net zero emission by 2060, and other countries in Asia such as South Korea, Japan, Vietnam, Australia, Hong Kong, they all have pledged to do the same by 2050, Thailand by 2065, and India by 2070. So we have strong commitment amongst the different countries within Asia to achieve this net zero emission. And also the region's central bank are highly supportive of green financing. So Singapore and Hong Kong, they have unveiled plans to expand their green bond markets. Policy-wise, Asian governments are looking to incorporate sustainability goal into their stimulus plans, which present investment opportunities as well. Okay, so they are also encouraging businesses to adopt their own sustainability agendas. So on top of environment elements that was mentioned here, we also see substantial social trend relating to the region's rising consumer class, but also risks related to quickly aging population. So aging population is also one of the themes that we look at in our portfolio. Okay, so in terms of governance, 43% of the world's top 5,000 companies, according to total revenue, are headquartered in Asia. So we do think that this is a huge opportunity or huge theme to look at as well. Okay. So when we speak about fixed income, we always want to know what is the growth potential in terms of issuance. So we won't be caught in the situation where we don't know whether there will be liquidity issue, where there will be bonds to invest in or not, right? So these two charts here is to show what is the debt issuance of sustainable debt over the past years. Okay, so the first chart speaks about different types of bonds or sustainable bonds that's being issued. So if I could quickly share with you, this is a lot of terminology. So green bond basically is where the projects, the funding or the projects is for environmental benefits. So like renewable energy, energy efficiency, climate change adaptation, etc. And social bonds are projects that address social issues. So the poor, the vulnerable, unemployment, and sustainability bond actually combines these green bond and social bond. So last is on sustainability linked bond. So this is where the bond instrument, the financials can vary, but the projects itself do have a sustainability or ESG objective. Yeah, so it's probably not clear cut that is for environmental or for social, but it does have the sustainability element in it, right? So if you look at this over the past year, it has actually grown for almost double in terms of the issuance in Asia. And if we specifically look at Asia Pacific, that is under this orange bar here, the issuers for Asia in 2020 to 2021 has grown almost 3 times. Okay, so we actually have abundance of opportunity in investments for Asia fixed income, sustainable Asia fixed income. And after knowing that we have sufficient issuance and the space is growing rapidly, I think we should also look at performance, right? So for some of you who are very detailed, you might say that, oh, actually the overall issuance of ESG bond is increasing. So not just Asia. Then why should we look at Asia? Okay, so here, let's first maybe start looking at this cumulative performance. So this is the cumulative performance of ESG global bonds versus ESG Asia bond over the past close to 10 years. So this is from 2012 December. Okay, so the cumulative performance for ESG Asian bond is at about 40% versus our global counterparts at about 12%. Okay, so this is quite a significant differences in terms of performance. If we analyzed it, the return is for 3 years is also stronger for Asian bond compared to the global bonds. And if you look at duration, which is quite important given the increased interest rate environment, we do have ESG Asia bond having lower duration and a higher yield to maturity. Okay. The other common question that you might have is also whether I'm sacrificing return to do good. So instead of just comparing ESG bond versus ESG Asia bond versus the global bonds, let's look at ESG versus non-ESG as well. So this chart here compares the cumulative performance for similar period between ESG Jackie, which is the ESG Asia Bond Index, versus the normal JP Morgan Asia Credit Index, which is the usual Asia Credit Index. I would say the return is not significantly different. So we can safely say that you are actually getting the similar return and at the same time being able to do good, right? So specifically, if I'm looking at the carbon intensity, comparing our fund versus the ESG Asia Credit Index versus the usual Asia Credit Index, the fund has almost less than 50% of carbon intensity compared to the ESG index, and it's only about 1/5 of the usual Jackie index. So you're not sacrificing your return, yet you are able to contribute to the whole carbon footprint intensity by investing in ESG bonds. Okay. So the next 2 slides, I'll briefly show you what our investment team is doing and how we work so that you have a rough idea on how they do the selection. So we combine the Asia Credit Research team and they work with the ESG research team. If you still remember, we do have a dedicated ESG research team to create this particular portfolio. Sorry. So we take a very holistic approach to build this solution. to generate a sustainable risk-adjusted return. So we have ESG integration in investment process. On top of that, we do have a normative screening to avoid companies with negative impact and also focus on the best-in-class issuers with low ESG risk. We also actively increase our exposure to ESG theme bonds. I'll talk about these ESG theme bonds later. And we also engage in all our portfolio companies at least once a year, so that we try to achieve also positive impacts on the three main themes that I've shared earlier, which is on climate change mitigation, aging population, and strong governance promotion. Okay. So looking at our fund, I will skip this slide. We have talked quite a bit on this. This is a comparison chart about some characteristics of our fund versus this is the ESG index, which is our benchmark, and this is the usual Asia Credit index. Okay, so I would say for this fund, the average credit rating is investment grade. So the splits that we can go between investment grade and high yield bonds are 65 versus 35. But right now it's at about 70%. So we have about 70% in investment grade, and the average credit rating for the fund is investment grade. Okay, so the yield to maturity is about 5. We have managed to bring down the duration to about 4 years, 4.2 years. And here I would like to kind of channel your attention to this exposure to ESG bond. So for the fund, we have a specific dedication to how much ESG bond we want to have exposure on. So we are not saying that we don't just do negative affirmation. So we don't just say that we don't invest in casino, don't invest in fossil fuel. We also actually have a commitment to invest certain proportion into ESG bonds. So the target is at 10% and having an annual increase of 5%. But if you look at what we have as of January, is at 32% right now. And compared to our benchmark at 12, and this is the usual Asia Credit at 8%. So you might ask why we only have 32%, why not 100%? It is really due to what's available in the market. And we also want to be very prudent and avoid greenwashing. So we don't just invest in all green bonds that is issued to be a green bond. We would actually do a very holistic approach or screening that I've shared with you earlier to really understand what's the purpose of each project, whether the other projects of that company or the general direction of that company, whether they are moving towards ESG. Okay, so this fund is an SFDR Article 8 fund, which means that they are promoting environmental and social characteristics, and it is also an MSCI A rating fund. Okay, so this is the geographical breakdown. I will not go into details. It's quite diversified, and on the industry as well, it's quite diversified. So for the fund, the main detractor in January was the Chinese property sector, which unavoidably, I think across the market, that's what we have seen, whether it's on the ESG or the non-ESG side across Asia fixed income. I think that's quite standard over the past month. What has helped the fund or what we have added on the fund is one new social bond issuers in India financials, and also one South Korea financials, which are all best-in-class names. Now, I'm quite aware of overrunning, so I will quickly run through the next 3 slides is about the investment theme. So under each ESG, we actually identify a key theme to talk about or to look at for this fund. So under environmental team, we actually identify climate change mitigation as what we want to focus on. So that's the reason why, if you look at our carbon intensity for the fund, it is very, very low as compared to the benchmark and also the general Asia credit. And under the social team, we are focused on aging population support. So we are very focused on whether the companies do provide retirement solutions for their for their employees. I think that's very important. So we have the highest percentage of companies offering retirement solutions amongst us, and also between the benchmark and Asia credit in general. Last but not least, for the government theme, we promote good governance by, if you look at these are some of the key focus amongst the governance. One is on the balance between having female and male within the directorship. Secondly is on having independent directors. And also, yeah, so here you can see that these are the percentage. All right, so I'll not go into this. We have already touched upon this briefly earlier. So this fund is available on PhillipCapital platform. These are some of the share classes, and these are the biographies of the investment team, which I briefly shared in the start of my presentation as well. Okay, so thank you very much. Happy to take any question that you guys might have about the fund.
Thank you, Janice. Thank you. We still have some time to take in some questions from the audience. Please do send in your questions if you have any before we move on to the next speaker. Right, I see that there are no questions for Janice. Right, if that's the case, well, thank you, Janice, for your time today, for sharing your time with PhillipCapital today. Thank you so much.
Thank you. I hope those are helpful. Yep.
Right, thank you so much. Right, so now we have come to the last presentation for today's conference. The second fund feature presentation will be on the United Smart Sustainable Singapore Bond Fund by Mr. Edward Pei from UOB Asset Management. Anytime you're ready, Edward.
Yep, I hope you're seeing the right screen.
Yes, we are.
Okay, so
perhaps
I'm just going to go.
You want to switch over to the presentation mode?
Yep. Can you see the presentation? Yep.
Yes, this is good. Thanks.
Okay, that's great. Thank you, Josephine. Okay, it's definitely an honor to be invited to be part of PhillipCapital's annual ESG conference. Definitely great insight from the earlier panel discussion, and the timing to talk about investing smartly for a sustainable Singapore is simply at the right time. Now, as Luke has mentioned at the start, last Friday's Singapore Budget 2022. Which was delivered by our finance minister, Mr. Lawrence Wong. He actually made, great emphasis and charted a comprehensive path in developing a green, Singapore economy in the post-pandemic world. Now, to support, environmental sustainability, the Singapore government has actually taken the lead. It has, proposed to increase the carbon tax from 2024 onwards, and in addition, the public sector will support the development of green bonds by issuing up to 35 billion Sing dollars in green bonds. Now, this is definitely a win-win situation for the Singapore Green Plan. Besides, allowing Singapore to reach its long-term net zero emission goal earlier, this provides a great opportunity for the country to develop its green financial hub. Now, good afternoon, everyone. My name is Edward, and I represent UOB Asset Management. Now, I'm very excited today to be sharing, with everyone for one of our newest green fund. First of its kind, made in Singapore bond portfolio with a proprietary ESG focus, supporting the nation's call for sustainability. Secondly, high quality portfolio with stringent ESG and risk management filters, providing a sustainable income on a regular basis. And thirdly, giving retail investors an opportunity, to be one of the first to participate in the sustainable finance and impact investing market in Singapore. Now, I will do a little bit, something different, which is, since we're now on the topic of climate change, let's quantify the amount of carbon dioxide that's, being released into the Earth's atmosphere over the course of this presentation. Now, I will revisit this at the end of my presentation. So let me just start the CO2 counter. Okay, it's ticking. So moving on. I'll be spending the next 25 or 30 minutes or so to articulate, firstly, the case and demand for impact investing and sustainability in Singapore. Second, a product solution to participate in this cause. And lastly, the details of this United Smart Sustainable Singapore Bond Fund. So the case and demand. Now, yield has been the focus, last and this year, more so of this year. But that being said, it has not been a very positive year for all of us. Global markets have been choppy since the start of the year, as the sentiment oscillated between optimism and uncertainty over geopolitical, climate, consumer trends, fiscal and government policy, as they're constantly unfolding and changing throughout the world. Nevertheless, on the Omicron variant front, it appears to be less dangerous than Delta, unlikely to derail growth, but we are also seeing rises in the number of daily cases around the world, including Singapore as well. Now, and next is, of course, one of the major concerns that we are seeing is central banks around the world are pivoting, toward tighter policy. However, that pivot isn't uniform across the world because policy stances and the severity of the inflation shock differ among countries. Now, there's of course no shortage of liquidity yet. Real money still remains plentiful. And in terms of inflation, inflation stays at elevated levels, but we believe, there are pockets of opportunities remain through active management and getting tactical when it comes to duration of the portfolio sensitivity to interest rate. We also want to be choosing good names as well. And lastly, you have been seeing 10 years treasury yields peaking in 2022. But looking at where cash returns are, they are likely to remain low. And of course, even though it's not shown inside here, the Russian-Ukraine conflict escalation is creating knee-jerk reaction in the market. Now, this actually alludes to the importance of selecting a fixed income product that is able to provide a sustainable yield that also provides stability and income in such market conditions where we have different variables that is moving around. So why is income important now? Now in Singapore, there continues to be a significant rise in bank deposit. So in mid-2021, it is estimated that over 700 million of uninvested cash are still sitting in deposit accounts. Not allocated efficiently to higher yielding investment. This despite fixed deposit rate being lowest since the 2011 European debt crisis. In addition, from a sustainable investing perspective, we are also seeing an increase in demand of ESG-centric products. From 2019 to 2020, global ESG fund saw about 2.3x increase in inflows, and closer to home, Asia ESG funds actually saw an almost 20x increase in inflow. So does impact investing really translate to a better performance? Now, in its review of over 1,000 research papers from 2015 to 2020, academics from New York University, NYU, found an overall positive relationship between ESG investing and performance. Now, number one, 59% of the ESG portfolios perform better than or similar to their non-ESG counterparts. 65% of investments that consider climate risk perform better than or similar to non-ESG funds, as well as lastly, 58% of companies show a positive link between their ESG performance and corporate metrics like stock prices. So how do we invest smartly for a sustainable Singapore? Now let's talk about what most important investing. That is definitely profit, right? So let's look at the credit quality of Singapore first. So Singapore, compared to the rest of the Asia, is the only triple A-rated country in the region. This means that bonds issued by local and Singapore-based companies denominated in SGD will correspond with this high credit rating. In addition, Singapore is the financial hub of the region, offering good platform for administering investment products relative to other countries. Hong Kong is at AA-, China A+, and of course, Malaysia at BBB+, and India at BBB-. So if you can see from the spectrum, Singapore is is one of the highest credit quality. Now, from a GDP growth perspective as well, Singapore compared to the rest of the region delivered one of the highest GDP in the ASEAN market in 2021. Now, albeit the strong momentum in 2021, we are likely to see a more sustainable growth in 2022, estimated at about 3.5%. And in terms of issuance, now, despite the whole turbulent financial market during the pandemic of 2020 and 2021, Sing dollar bonds issuance remained very resilient. This means there is still a healthy and ample supply of debt instrument available coming out of Singapore. Furthermore, issuance are, you can see from the pie chart over here, are dominated by high credit quality government, quasi-sovereigns, real estate REITs, and of course, financial insurers as well. And looking at 10-year government bonds, bond yields across developed markets, Singapore compared to other developed nations offers some of the best yield, trailing behind Australia. Now the 10-year SG government bond yield about 1.99%. Higher than US Treasuries, the UK gilts, and definitely much higher than the German Bunds. And okay, so we are convinced with how strong Singapore is and where it stands relative to other countries. But from a macro point of view, what about the investment returns, right? So over the past 3 years, Singapore bond funds return an average of about 3.5% per annum, with a standard deviation about 3.6%. And if we do, a simple return over risk calculation over popular asset classes, you see that Sing dollar bonds returns, Sing dollar bonds actually offer the highest amount of returns per unit of risk. Now, this is much higher than the likes of your global equity, Asia Pacific as Japan equity as well, and also global bonds. And in terms of crisis, right, how does Singapore bonds actually hold up in time of crisis? Now, this chart plots the performance of Asian bonds, global high yield, emerging bond, global equities, and Singapore bonds over 5 significant crisis events. Now, the 5 events are your global financial crisis, European debt crisis, China's stock market turbulence, trade war concerns, and start of COVID-19 pandemic as well. And in most scenarios, Singapore bonds prove extremely resilient, and hence the asset class will help to buffer portfolio drawdowns when markets enter a turbulent period. Next, let's talk about the purpose. Since this is a sustainable fund, why must we choose to invest in sustainable Singapore bonds? Now, climate change is real. Now, with every rise of 0.5 degrees Celsius in global temperature, we will, experience exponential damage caused by heat wave, drought, and flooding. Now, this will eventually put a large part of Southeast Asia underwater. There isn't a need to look so far. In Singapore itself, we have seen several events of flooding this year in various parts of Singapore. Last year, most recent being Bukit Timah stretch of road. So much for once in 50 years. It seems like a major flooding event will now occur once in 5 months. And perhaps Temasek Foundation, instead of issuing free masks right now, they should be actually, starting to issue free life jackets. So, this is just for the fun of it. So the thing is that, if we don't do something, there's a risk that garden by the bay might become garden below the bay. And in all seriousness, this is actually a wake-up call on the importance of climate change as well. Now, the growing importance of sustainability in Singapore has actually led, to the recent rebranding of the Ministry of Environmental and Water Resource to the Ministry of Sustainable and Environment, headed by Minister Grace Fu. Furthermore, the issues surrounding sustainability is multifaceted and requires substantial funding to support immediate action and strategic long-term solutions, which will enable Singapore to achieve its goal of a climate resilient and sustainable future. Now, the Singapore Green Plan 2030 is a national sustainability movement which seeks to rally bold and collective action to tackle climate change. This was announced in 2020's national budget. Now, 19 billion worth of public sector projects to be, financed through green bond issuance. To go green, major infrastructure projects will need to be developed, and under Singapore's new Significant Infrastructure Government Loan Act, SINGA, of this new Singapore bonds issued, there's a high possibility that these green bonds will be green sustainability linked bonds. Now, as government issuance grow, corporate interest in Singapore will likely follow and grow as well. Now, this translates to large potential of new corporates green bonds in the coming year. Additionally, as I have mentioned in the start of the session, the government bond has Singapore government has also, provided a strong commitment in the public sector, doing its part to develop, a robust green finance market where they aim to issue up to $35 billion of green bonds by 2030 to fund public sector green infrastructure project as well. And of course, in response to our government's call for a push in sustainable finance, our central bank, MAS, Monetary Authority of Singapore, has also set up initiatives to support the country in promoting environmentally sustainable projects and mitigating climate change risks in the region. Now, a very good example of a highly rated ESG bond is actually in this slide over here, CapitaLand. Now, aside from winning, multiple BCA Green Marks Award, the new project that CapitaLand embarks on involve embracing advancement in innovation and technology in construction, creating resource efficient property developments as well. So, in this case study itself, you can see that they have a very high ESG rated bond by CapitaLand. And now, I think, previously, Janice also actually mentioned, does it pay off to adopt ESG? I guess, yes, it does. The table and the chart here maps two indices of the JP Morgan Asia Credit ESG Index, or the JACI, what we call the short form, the JACI ESG IG, and the conventional, the conventional non-green issuer, which is the JACI IG index. Now, since 2013 to date, right, ESG credits have actually performed better than conventional non-green issuers. Now, looking at year-on-year performance, the JACI ESG index has outperformed the JACI conventional IG index in 5 out of 9 periods. Now, the average return is slightly higher for JACI ESG IG as well. Now, this adds to the compelling point that, ESG and green bonds are seeing better opportunity as institutional and retail investors start to appreciate the concept of impact investing. Furthermore, according to Bloomberg Intelligence, over a third of the US 140 trillion in projected total total AUM by 2025 is expected to be ESG linked. Now, that means we expect about US 53 trillion worth of ESG investment worldwide by 2025. Now, lastly, let's talk about the payout of the United Smart Sustainable Bond Fund. Now, the fund was actually incepted last year on 25th October 2021. The dividend payout, there will be a dividend payout of approximately 2% per annum, which will commence on April 2022, which is coming soon. And of course, why UOB Asset Management, right? Now, the thing is that As government put, climate change on their national agenda, companies in the regions are also firming up commitment, to slash carbon emissions and set net zero target too. Now, against this backdrop, the help of professional investment managers can be invaluable to individuals like yourself who are looking for sustainable investment solution that meet your financial and sustainable goals. Now, UOB-AM is one of the leading managers of Singapore bond funds, and it's one of the top rated managers. Now, we have a strong regional footprint and localized expertise. The investment process involves, blending our strong discipline issuer selection with our proprietary ESG screens. The ESG screening process we adopt identifies, sustainable growth and factors of the issuers, and on top of that, we utilize, artificial intelligence, machine learning technology to enhance sustainable issuer selection. Now, this results in a selection of issuers that are of higher quality to provide sustainable and above average returns, positioned for secular growth and well valued to capture alpha opportunities. Now, to just kind of briefly describe the ESG process. Now, we are actually proud to actualize our very own ESG screening methodology. The UOB-AM ESG scoring methodology is a proprietary scoring model employed by various investment professionals across investment teams and regional offices. We have our own ESG team, of investment professionals, and our proprietary ESG scoring model combines third-party data with independent UOB-AM ESG analysis and research, and building on such data, we also leverage, like I mentioned earlier, our AI machine learning model to monitor and screen controversy news. Most importantly, this enable us to remove the human emotions involved when reading or analyzing a news piece or a broker report. And finally, an ESG rating is determined through joint analyst reviews across investment offices. Now, another proprietary competitive advantage, that complements the fund manager, that complements our fund managers, our risk and performance unit. Now, the team actually offers an independent risk oversight. They actually take proactive approach to analyze and manage risk taking to ensure that our funds are managed according to their intended strategies and in line with the internal risk guidelines. Now, the Risk and Performance Unit also independently reviews and highlights significant performance and risk-taking issues, coupled with detailed analytics to have regular dialogues with the investment team to ensure blind spots are covered and addressed. And lastly, our initiatives and ventures into creating our own proprietary ESG screens and investment process has won us awards and recognition in driving ESG leadership that is made in Singapore. Now, this is our bragging right for achieving a first mover advantage for the local investment management arena. And to answer this new era of demand in sustainable investment, UOB Asset Management has taken meaningful steps since 2019 to expand our ESG teams and deepen capabilities in ESG investments, disclosure, and stewardship. Now, actualizing our ESG capabilities and expertise, we actually launched the United Smart Sustainable Singapore Bond Fund, or in a short form, we call it SSS. Now, the SSS fund actually seeks to deliver sustainable income to investors by investing in portfolio of primarily high quality Singapore fixed income securities. Now, the three factors include, of course, like I mentioned, first of its kind made in a Singapore bond portfolio with a proprietary ESG focus supporting the nation call for sustainability. You have your high quality portfolio with stringent ESG and risk management filters, and also one of the first to actually participate in the sustainable finance market in Singapore as well, the three key features. And in terms of, country as a Singapore, we have seen, many ESG funds from international arena, but many don't realize, Singapore has some of the best fundamentals to facilitate and administer sustainable investing products, to recap what I've mentioned earlier, Singapore has a strong capital market and one of the top financial centers in the world. Now, our strong government and open economy led the country to be ranked #1 in the 2021 Economic Freedom Index, and it is the only country in Asia with a AAA sovereign rating by S&P, Moody's, and Fitch. So the fund's investment teams directly support Singapore Green Development Plan as well, especially in these three key areas. Now, the SSS aims to contribute to solutions that can reduce and remove the harmful impact of climate change. The SSS actually invests and explores the use of innovations and technological solutions aimed at creating a green, clean, and smart Singapore. And as well as the fund actually aims to ensure that the production of goods and services is sustainable at all times, including establishment of resilient and sustainable supply chain. Now, the SSS bond funds invest predominantly in high ESG rated Singapore issuers from a diversified range of sectors. Many of these are Singapore corporates who are leading player in their own industry. We also allocate into green social sustainability, sustainability and sustainability linked bond, or the GSSS bonds, which are of higher quality and higher yielding bonds. And one important thing about the fund is that we also track and measures the ESG impacts of its investment. Now, our proprietary impact dashboard and scoring software helps to understand the sustainability performance of the fund, as well as the sustainability impact from investment made into the underlying bonds that are mapped to the core investment themes, which mentioned earlier. Now, based on the weighted average scoring of the underlying constituent, the dashboard is able to quantify impact measurements. Now, to put things in a more interesting perspective, our impact matrix show that the carbon intensity impact for every 1 million Sing dollar of revenue generated by the portfolio, we can achieve CO2 emission reduction equivalent to 3,154 round trips from CBD to Changi Airport. And for every same $1 million of revenue generated by the portfolio, we can achieve energy savings equivalent to powering 261 3-room HDB flats for 1 month. And in terms of water impact, we can actually achieve water savings equivalent to 6.9 million large size bubble teas. And of course, in terms of supply chain environmental costs, that every $1 million of Sing dollar revenue generated by the portfolio, we can actually achieve supply chain environmental cost saving equivalent to 1,864 packets of chicken rice. So I guess these are very much relatable to our daily life, and you can see the amount of impact that we are actually generating. Now, here are the main characteristics of the portfolio. Investment grade average portfolio with each individual issuer screened within our proprietary ESG rating system. At least 70% of the allocation to Singapore issues. All non-SGD issues are hedged to SGD to minimize and mitigate the FX risk. There's a 20% cap maximum higher exposure as well. And of course, you have your average portfolio yield about 3.05% and duration about 3.64 years. And of course, these are the sector allocation and the credit quality allocation. Now, just move on to the fund details. Some of the fund details over here, benchmark, base currency, and I won't go too deep into it. These are the different share classes, and of course, the AUM size as well. Yep. And of course, just to go through some of the key fund risks, which all investment actually carry risk. So yeah, this can be actually found in our prospectus as well. I won't dive too much into that. And let me see. Okay, so I'm just going to stop the counter here, and later we will see what is this equivalent to within the time period of my presentation. So I've stopped the counter, 611 kilo metric tons of CO2. Now, okay, so this I will just summarize. The triple S portfolio actually aims to deliver 3 Ps. Very easy to remember: profit, attractive yields with a focus on balancing risk and return via investing into a predominant portfolio of Singapore debt securities. Purpose, investing in the new era of sustainable finance, in line with the nation's call to action for impact investing. Now payout, achieving a sustainable regular dividend income of approximately 2% per annum. And ladies and gentlemen, this is the United Smart Sustainable Singapore Bond Fund. Thank you so much for your time on a lovely Saturday afternoon. So, yep, thank you so much. Yeah, so just now I was just sharing the how much CO2 emission while I was actually presenting. I'm just going to show you just quick one. So it was 611. Just one moment, yeah. 611,000 matrix, and I'm just going to calculate, and then I'm just going to share screen again. And during the course of the presentation, you can see that now this is from the United States Environmental Protection Agency website. Now this is the amount of greenhouse gas emission that that we had while we were having our presentation. Now that's quite interesting, right? Yeah, so that's about it, and thank you so much.
Thank you, Edward. Thank you for your sharing on your newest green fund. So both the United Smart Sustainable Singapore Bond Fund as well as the Manulife Sustainable Asian Bond Fund are both available on the PhillipCapital's platforms. So thank you, ladies and gentlemen. We have now come to the end of today's ESG conference, and this event is proudly organized by Phillip Unit Trust. Invest with Phillip Unit Trust and you can enjoy 0% platform fee. What's more, you will have access to a wide range of more than 2,000 retail and restricted funds. In addition, we are also running a transferring promotion where you will be able to receive up to $1,000 credit when you're transferring your holdings to Phillip Securities. Terms and conditions apply. So for more information on Phillip Unit Trust, please check out our website at unittrust.com.sg. Visit any of our Phillip Investor Centers or speak to your favorite financial representative. Thank you once again for being part of today's event, and we definitely hope to see all of you again soon. Stay safe, everyone. Thank you.
Thank you.
Thank you. Thanks, Stefan. Thank you.